What is Driving Sale and Leaseback by Camilla Cheddar. In this video, we will begin by having a look at what is sale and leaseback, why should we be bothered about it, and then the fantastic 5 driving forces behind sale and leaseback: tax, finance, flexibility, focus, and accounting. Sale and leaseback is where a company sells a part or all of its property portfolio to a third party and then leases it back from them for a specified term. Norse 1994 finds that firms that lease their property perform better since they are able to align their property decisions more closely with strategic business needs. This happens because leasing makes it easier for firms to consider and identify all the costs associated with the property. For example, it's easier to recognize rent payments as opposed to the opportunity cost of holding a freehold property. This ensures that real estate assets are put to their highest and best use. Recent evidence also supports this. For example, JLL found that owner occupation fell by 3% in 1 year. Now we will turn to examining the 5 driving forces behind sale and leaseback. First driving force is tax. So in the US, property attracts a depreciation tax, which means that it encourages firms to lease rather than own so that they don't have to pay depreciation tax. This is quite different to the situation in the UK, where the annual tax benefit to be had actually arises through corporation tax, which is that if you rent property, then obviously this is a cost and your profits go low, and then your corporation tax that you need to pay also goes less. So that means that the rental payments can offset the corporation tax you would have to pay otherwise. It is important to consider, however, that sale and leasebacks may also attract a VAT leakage. So this can happen in 2 ways. First, if a company is a VAT registered company, then when it sells a property, the sale will attract a VAT price, and on that, a stamp duty will also be attracted. These additional taxes make it very expensive, and the investor may usually look to ask the person selling the property, so the firm, if they would like to or if they can pay a part of the tax. Secondly, if a company has carried out any works on the building in the last 10 years and has a VATable business of less than 80% of total sales, then this could have the option of disapplying its option to regain the tax benefit. So what happens is if they carried out works and they were VAT exempt, so they got the money back, but this happened, but they're selling the property now when less than 10 years has passed, then for the remaining years the VAT exempt that they got and the money they had got back from HM revenues has to be paid again to them. So this is a VAT leakage, and this does impact the way sale and leasebacks are conducted, but there are ways around this. And so if you find the right company to do it with, it's still a major tax benefit for the companies. Second key driver is finance. So sale and leaseback results in a release of capital. This thus is a mechanism of financing. This capital can then be optimized through investing into the core business and or reducing borrowing. So in order to do this, the directors and the shareholders of the business need to be able to split the company between its operational side and the property side. This is known as OpCo-PropCo divisions. The conventional means for evaluating these different companies as they were is also different. So for example, with OpCo you use earnings per share, and with PropCo it's net asset value. Now this is significant because having this net asset value measurement makes it easier for the PropCo company to borrow on, and also to forecast what would happen if the capital is released from PropCo and implemented into OpCo. Furthermore, the sale of the property can be improved if the company is linked to a financial institution that can lend to the buyer. This is known as stapled finance. This is a sweetener to the deal because it removes the investor's funding risk and it increases the amount of potential buyers. So Aviva, in this project called Project Ed, they managed to get 29 bidders who were sitting on the fence beforehand. So in sum, basically, in the UK, the principal motive for adopting sale and leaseback is finance. It's a source of financing. The third driving force is flexibility. Sale and leaseback, contrary to common perception, can provide increased flexibility. And this is because it leasing allows the company to tailor and utilize real estate to its specific business needs. So two good case studies we can look at are Tesco and Barclays. Now I have a video explaining Tesco, but essentially by embarking on a joint venture, they were able to ensure that they retained control, which for them is what they needed. It's the element of flexibility they needed in order, restore, redesign, etc. So they embarked on doing sale and leaseback through a joint venture, which allowed them to gain increasing flexibility with their property while releasing capital. In Barclays, this is a similar situation, and what they did is they got flexibility through varying lease terms by selling off each property individually as opposed to the whole portfolio to one landlord, and this also allowed them to keep up with changing business needs in terms of the retail and the non-retail side of banking. So sale and leaseback provides that flexibility, and it's a really key driving force. Sale and leaseback also allows firms to focus on the actual business. So what they do is it allows companies to move away from property where they may not have any expertise or interest, or they might not need it, it's non-core to their business, and reinvest that money into the operational side of their business. And also, if you think about the return on property is 6 to 8%, whereas the return from the actual business can go up to 25%. So you're getting more out of your capital, and this allows firms to focus on what they're doing, use that capital for research and development. And IBM is a great case study because essentially they kept one property, but the rest they did this sale and leaseback, and it was just amazing because in essence they got the flexibility, they got property on demand, and they were able to improve their sales and research into their core business, which is what they were after. Accounting is the next factor to look at. All leases create assets and liabilities. At present, however, most leases are operational leases and are so not reported on a company's balance sheet. Leases are considered an operational expense and stay off the balance sheet. Problem is that long-term leases bear the most risk, and this should actually be reflected in the balance sheet. The way financial leases are. Financial leases are those leases which are treated as a loan payment, so as an asset. In light of this, the International Accounting Standards Board issued a revived exposure draft in 2013 to harmonise accounting practices and put all leases back on the balance sheet. So all leases now will be viewed as on a right-to-use basis, requiring the recognition of interest and amortization on the balance sheet. This means the cost of the lease will be higher in earlier years because you're present valuing the net rent payments over the course of the lease. And PwC found that debt balances could increase by 213% as a result. This will make leases with fixed rental uplifts less popular and shorter leases more attractive. The key is that the question of whether to own or lease will be more frequent at a board level, thus putting sale and lease back into the forefront of companies' decision making. In sum, sale and leaseback, despite these accounting uncertainties and the negative influence that the accounting practices will have on sale and leaseback, it is continuing to become more and more popular in Europe particularly. This is because of the many advantages it brings, the flexibility, for example, the focus, and that it almost always has a positive reaction from markets, and there are also personal motives that the firms may feel they can only achieve through sale and leaseback. For example, IBM needed to have property on demand. Thank you for watching. Please visit my website www.camillachada.com.